everyone, welcome to EduTap. So in today's session we are going to discuss a very important news article of finance that is regarding the Reserve Bank of India that has announced the measures to increase the foreign exchange inflows into the country. As well as you all must have heard that the rupees is continuously depreciating against the dollars and the dollar is becoming strong. So to control such kind of situation, the RBI has taken different measures that we will see in today's session. So now before starting with the session, please subscribe to our YouTube channel if you are new to the channel and join our Telegram channel for the PDF of this session. And you can get the link of the Telegram channel in the description box below. So now starting with the RBI's measure to increase the foreign inflow, that is the liberalization of the Forex flows is happening, and the different measures is taken by the Reserve Bank of India that has been shown in the RBI's website in July 6th, 2022. Okay. So before starting with the measures, what has been said in the liberalization of Forex flows, this article is that the global outlook is clouded by recession risk, that the global economy has suffered from the COVID-19 and after that it suffered from the geopolitical tensions, as well as seeing the high inflation that came due to the geopolitical disruptions and the geopolitical tensions, that is the Russia-Ukraine war. There was high inflation that is coming not only in India but in most of the advanced economies, in most of the emerging market economies, in all the countries we can say that the inflation is growing very rapidly. The inflation is growing very rapidly and the growth has been low due to COVID-19. During the COVID-19 in many of the countries there was negative growth that was happening. So the growth was low and after that Russia-Ukraine war started, so the inflation rose to a new high. After that the policy, the reserve banks or the central banks of most of the country, they started normalization of monetary policy, that is to increase the interest rate to control this inflation. Okay, I have already told you in the previous session that how by increasing the interest rate the inflation is controlled. So the countries were increasing, the advanced countries were increasing their interest rate to control the inflation. Even India has raised its repo rate. Okay, so that is the interest rate was raised to decrease this inflation, to control this kind of inflation that brought volatility in the foreign market, that brought volatility in the global financial markets, in the financial markets of the specific countries also. Why? Because when the interest rate is raised of one country, let's say the interest rate was rising in America, in Europe, so the money was flowing to those countries. As well as when the volatility is very high, the people become risk averse because the growth is low, the inflation is high, so there are chances of stagflation, that is stagnation, as well as inflation. The chances of stagflation and the inflation are very high, as well as the recession is expected to come also in the economy. So either the stagflation or the recession, something or the other trouble will come in the global economy, that is expected by the market participants, that is expected by the stakeholders. Okay, so as seeing so much trouble that is coming in the global market, the participants, the investors became high risk averse. Okay, they do not want to take the risk now because their money will get stuck, or the foreign currencies, you can see that most of the currencies of the countries are getting depreciated against the dollar. So they have become very risk averse and they want to keep their money safe, and so they have started buying dollar into high amounts. The demand for the US dollar has increased to a great level. Why? Because the dollar is considered as a safe haven. Okay, dollar is considered as a very safe currency because the US is the one of the most advanced countries of the world. Okay, so seeing this global outlook, the high aversion, everything, the investors, the market participants, they have shifted to buy, to demand the US dollar so that their money, their investment can be kept safe in the dollars. Okay. So now the Indian rupee has depreciated as the demand for the US dollar is very high, and from all the countries, from all the emerging market economies, from even the advanced economies, the money is flowing to the US. The people are buying, the investors are buying the dollars in huge quantities. So the demand for US is very high. When the demand of a currency is very high, then the supply, then of course the value of that currency will increase, because when the demand is greater than supply, the price will increase, that is the value of that particular product, the value of that particular currency will increase, and so the US value is increasing. The US is becoming stronger and stronger, and we have seen that the Indian rupee has depreciated by 4.1% against the US dollar during the current financial year, that is 2022-23, that started from April 2022 So far up to July 5th, as per this article by the Reserve Bank of India, which is modest, which is still not as bad as we think. This is said by the Reserve Bank of India because in relation to the other emerging market economies and even the major advanced economies, even those currencies are depreciating against US because all the investors, most of the investors are trying to demand the US dollars. Okay, they are trying to invest in US. Okay, so that their money, their investment can be kept safe in the safe considered US dollars. So the Reserve Bank has been closely and continuously monitoring the situation that is happening in the financial market of not only our country but in the global economy, what is happening, and the liquidity conditions that is there in the forex market, as well as to stop the depreciation, of the rupees, to stop the reduction in the value of the rupees. The RBI has already used the reserves. Okay, it has already tried to increase the supply of the dollars in the Indian market. Okay, so that the depreciation of the rupees can stop, at least can decrease at least. But what happened that even though the RBI has tried to increase the supply of the dollars and the RBI reserves, foreign reserves, has decreased, and from $600 billions, it has decreased below, it has gone below $600 billions. Still, we can see that the depreciation is continuous. Depreciation is still happening even though the RBI has tried to increase the supply by reducing its foreign exchange. The RBI has tried to increase the supply of dollars in the economy. But still we can see that the depreciation is continuous. Still it is happening. So that's why RBI thought that we have to elevate the tightness in the dollar so that the demand of the dollar can be reduced, and the objective is to ensure orderly market functioning so that the market can function properly. The demand should not be very high of the dollars. Okay, so for that there are measures that has been taken, announced by the RBI. It is both for reducing the depreciation of the rupees as well as to increase the foreign inflow. Okay, foreign exchange inflow in the economy. Okay, so that the rupees can become stronger against the dollars, at least by a little. Okay, so for the first step that is taken is exemption from the CRR and the SLR on the incremental FCNR and the NRE term deposits. CRR is the cash reserve ratio, SLR is the statutory liquidity ratio. These are the reserves that the bank has to keep. Okay, if the bank has 100 deposits, this is the liability of the bank because the bank has to return the deposits to the depositors. Okay, this 100 rupees, that is the deposit that is with the bank, is the liability of the bank that the bank has to return. So from these 100 rupees, the bank has to keep the CRR with the RBI, and the bank has to keep from this 100 rupees, the bank has to keep some statutory liquidity ratio with itself. Okay, that when the depositors come, the money can be given to the depositors. So a part of this total deposits, net demand and time liabilities, from this the bank has to keep some SLR with itself. So let's say after keeping the CRR, after keeping the SLR, the bank has left 70 rupees. So this 70 rupees the bank can give as the loans to the customers. Okay, so this bank has to keep the CRR and SLR from net demand and time liabilities from all the deposits that the bank is getting. Now what is this incremental FCNR? This is the foreign currency non-resident bank deposits that is happening, that the non-resident Indians, they are also depositing in our country. Okay, this NRE is the non-resident external deposits that is happening. So the RBI has said that the reporting fortnight beginning July 30, 2022, incremental FCNR and the NRE term deposits with a reference base date of this will be exempted from the maintenance of CRR and the SLR. That is, the banks will not have to keep the CRR and the SLR on the deposits that is coming from the non-residents. That is the incremental foreign currency coming from the non-residents. Okay. So a non-resident external account is a bank account that is by the non-resident Indians to deposit their earnings from the abroad in Indian rupee. So the person, the non-resident Indian, is sending dollars. It is earning in America, so it is sending dollars into the country, into the bank account, and then this dollar is converted into the rupees at the current exchange rate, and then the rupees is stored into the bank account. Okay, so through this the money, the inflow is happening of the dollars. Okay, through the NRE account through the NRE deposits, as well as FCNR, that is the foreign currency non-resident deposits. This is an account that allows you to save your money, the non-resident to save the money earned overseas in a foreign currency, so they can keep their dollars into the deposit, in the term deposit into our country. Why they will want to keep their deposits into our country? Because first of all, it is tax free, second of all, it is fully repatriable, they can take back their money. Okay, so foreign currency they can keep. The non-resident Indians, they can keep their money in the NRE account or the FCNR account, as well as these, it has been said that it will be CRR and SLR free, that the banks will get to keep the 100. They will not be keeping 30 with the RBI or with themselves, but they can use this whole 100 rupees that is coming from the foreign, that is coming from the non-resident Indians. They can use this full 100 to give as loans. So it has become very incentive, like you can see the incentive in front of the banks, that they can use the whole money, whole deposits to give the loans. So for the banks will be asking the non-residents, they will be boosting, or they will be like promoting that the non-residents should do more and more deposits, so that more and more foreign reserves can, foreign exchange can come into the country. And this is allowed, this relaxation is only available up to for the deposit mobilization. This is only up to November 4, 2022. Okay, so this is for the deposit mobilization from the non-resident Indians, so that more of the foreign currency can come into the country, and that's why the relaxation has been given, that on the foreign deposit on these accounts there will be no CRR and the SLR that the bank has to keep. So what is the incentive for the account holders, for the non-resident Indians? Why they will want to invest into our country? Why they will want to keep their money into our country as the savings, as the deposits? So it has been said that before there were interest rate limits that the bank can give to the non-resident Indians, but that interest rate limit has been lifted up. It has been said that now there is no interest rate limit. You can give, the banks can give as much interest as they want. Okay, before if they were giving 2%, 3%, 5%, now they can give 6%, 7, 8, 9, 10%, any percent that they want. Okay, so that is as per the existing regulations, there were the limits that were there, and these limits has been temporarily permitted. Banks means the limits has been temporarily raised on the fresh foreign currency non-resident bank account and the NRE deposits. Okay, so this relaxation will be available for the period up to October 31, 2022. So now there is no interest rate limit that is present. Okay, so there is no existent regulation that is to be followed on the fresh foreign currency on the FCNR bank account and the NRE deposits. Otherwise they will have to follow the existing regulations on the interest rate, but now they do not have to follow until the October 31. So now it is also beneficial for the non-residents to invest, to save into our country, because they will get higher interest rate, because it is beneficial for both the banks and the non-resident Indians. The banks will not have to keep the SCRR and the SLR on the deposits that are coming from the foreign, as well as the non-resident Indians will get the higher interest rate, because of course the banks will want more and more deposits to come from there, and for that they will be ready to give higher interest rate also. So that will promote both banks and the non-resident Indians to save more into the country, into India, and the banks will want to have more of the foreign the deposits that is coming from the non-resident Indians. So now foreign portfolio investment in debt. So now what happened, that the foreign portfolio investors can invest through the fully accessible route into the three categories of the government securities, that is 5-year, 10-year and the 30-year government security bond they can have. But now to expand their portfolio, so that they take more of the bonds, so they buy more of the bonds, so that more of the foreign exchange can inflow into the country. It has been said that the choices will be increased for the government securities, that is now they will also be made available of the 7-year tenure of the government securities and the 14-year tenure of the government securities, as well as the current issue that has happened for the 7-year tenure, that is up to 29, and the 14-year tenure, that is the government securities that will be mature in 2036. Even in those new issuances, the foreign portfolio investors can invest now. Okay, so through the foreign through the fully accessible route, there are more government securities, there are more choices that has been given to the foreign portfolio investors. As well as through the medium term framework, it was said that there is a short term limit, that how much you can invest in the short term bonds, in the short term corporate bonds or the government securities. That was not more than 30%, that only maximum 30% you can invest in each the government securities and the corporate bonds, but this limit has been lifted up. Okay, and this 30% can have a residual maturity of less than 1 year. That is for the short term bonds, short term government securities. You can only invest 30% each in the corporate bonds and the government securities, but this limit has been lifted up by the government. So by the RBI, it has been decided that investments by the foreign portfolio investors in the government securities and the corporate debt made till October 31, 2022 will be exempted from this short term limit of the 30% on each corporate bonds and the government securities. Okay, understood that now they can invest as much as they want in the short term. Okay, that is if they want to do 50%, 60%, 70% of their total investments. From the total investments, before there were limit of the 30% that can happen in the short term, but now there is no such limit. Okay, next, so this is the summary that you can read. In brief, all the points has been declared here, has been given here, that there will be no CRR and the SLR on the deposits, on the NRE bank deposits, FCNR bank deposits. There will be no interest rate cap, that has been removed, and the other things you can also see. As well as the external commercial borrowings, like before the limit was $750 million, but the limit has been raised to $1.5 billion. Okay, before the limit was this, but now the limit has been raised to this. That is, the private sector can have more external borrowings now. They can do more external borrowings. The private sector, the private companies of our country can have more commercial borrowings from the foreign. Okay. So that's why the limit has been raised from this to this, so that more inflow of the foreign currency can come, the more inflow of the dollars will also come. Okay, and the reserves of the Reserve Bank of India will also increase, the foreign reserves. So this was all for today, the measures that we have discussed. If you have any query, you can mail us here or you can contact us through this number. Thank you.